Hi guys, I'm Kirandeep. Firstly, I would like to thank our professor for giving us this opportunity. Here we come with the product proposal and we select the chocolate glazed donut product for this, and we are the team of 6 people. Firstly, I would like to tell you the ingredients that we are going to use in our product, that is flour, sugar, cocoa powder, chocolate chips. That is optional. We can add it according to the taste if people want or not. Then is baking soda, salt, vanilla extract, egg, sour cream, milk, vegetable oil and the powdered sugar. The next thing is scope of product. In our product we are mainly focusing on the price. We will provide an affordable price that all people can buy it, and by this we can attract more customers and earn profit. The main target for our business is the people of London, as we are going to establish it in London. So we will try to satisfy the people there, and after getting some success here, we are planning to establish it in another cities like Toronto. Hopefully we will establish it by the next month, as we are done with all the planning for its establishment. The priority for our product will be the customer satisfaction. If the customer will be satisfied, we will attract more customers and earn the more profit. Next thing is product concept and the market impact. Main focus of our product is the healthy diet, as we are focusing on the all age groups, so it should be healthy, that they can we can attract more customers. We are providing more flavors, like we are using chocolate chips, dry fruits that can vary in the taste of chocolate glazed donut, and also we are providing the allergic free donuts, that is there will be no gluten and walnut in our product. We are also providing various size donuts, like small, large, anything that people would like according to their capacity. The main motive of our product is to eat healthy, stay healthy. We are trying our best to provide a healthy product that people can stay healthy. For children, we are providing the donuts with less sugar and less calories, that is good for them, and hopefully with the time, like in the future, we will be popular in the North America too. We are hoping best for our product. Thank you. Next part will be presented by Path.
Hi, myself Jashanpreet Kaur. Now I would like to tell about our location. Our location is Huron and Highbury, and these are sites for our locations. And here we can say that our location, we are established our London pastry. And now let's start with area demographic and projection. And in 2017, and the total population is that 3,38,059, and the average household income 84,508, and we are expecting in 2022, and the total population would be 3,50,871, and the average household income $95,764. And the analysis, as we can say from the area demographic and the future projection, they are a good population, and the income income would be good if people will earn more money and they will spend more money, as we can say that there are a lot of shopping center, as there would be no problem of parking, and as we can say that there are lots of shopping center, the selling of our products is going to be good, and we are expecting sales of our product is 16,000 donuts for the first 3 months. Now master plan. The price for per dozen donut is $16.56, which would be precise for every kind of people. That's why everybody can afford it, and the location would be easy for reaching in our London pastry. That's why we are taking these locations, and we are expecting and we are producing 16,000 donuts in the first 3 months, and also would produce more donuts to get profit, which would be more depending on the people's demands. Now master budget. My friends already told about the master budget. Now sales budget and the sales. Dozens of chocolate glazed donut in January, 45, 100 in February, 5400 in the March 6480, and the total sales selling price per unit is $16.56, and the total sales is $74,529, and the sales are collecting in the first month is 40%, and the second month is 18%, and the third month is 40%, and the total cash sales is $29,812, and the total credit sales is 0 in the January, and the total cash collection would be 29,812, and the total would be 2,36,040. Thank you.
Hi everyone. So in my part I'll start with the operating and production budget and material purchases. So I start with the operating and production budget. So for the first quarter, so the number of donuts that we produced in January, February, and March are 4,500, 5,400, and 6,480. So the total donut that we produce is 16,380. So the operating expense per dozen is like 75 cents. So when you the total variable overhead is when you multiply by 4,500 into 75 cents, so it comes like 3,375. So and our total that's the same for the February and for the March. So the total variable overhead is 12,285, and the total overhead fixed overhead is almost fixed for every month. So it's 2,500 for every month. So the total operating expense is 5,875. It comes from 3,375 plus 2,500, so it comes 5,875. So total cash outflow for operating expense is 19,785. So the next topic is the material purchase. So for the first quarters, we start with the flour, sugar, and baking soda. So the number of donuts is for the January, February, and March are the same as for the previous slide. So the total number of the chocolate glazed donuts is 16,380. So the raw material required for the flour, sugar, and baking soda is 3.90 for January, 3.90 for February, and same as the March. So the total raw material required for production in cups are 4,500 into 3.90. It comes like 17,550 for the January, and if you multiply the same thing, it comes on February and March are the same. So the total number of total raw material required for the production is 63,882. And we have to add the closing inventory for the end of the period. So the closing inventory for the end of the period is for the January is 4,212. For the February is 500,054, and for the March is 6,065. The total is 15,331. So the total comes from that is the total raw material required for the purchase required for the production plus the closing inventory. So it comes from 17,550 plus 4,212. So it comes to 21,762. Same as February and same as the March. So as we're starting from the January, so our operating expense for the first one is like 0. So and for the February it comes 4,212, and from the March it comes 5,455. So the total operating stocks for the first quarter is 9,266. The total material purchased to be purchased is the 21,762 minus the opening stock. It comes 21,760, same as the February, and you can calculate the same as the March. So the cost per unit for the flour, sugar, and baking soda is 15 cents. So the total cost is 21,760 into 0.15. So it comes 3,264. So the total cost is 9,580. So let's start with the eggs. So the number of donuts are the same for January, February, and March. And the number of eggs per dozen required is for January is 1.20, same as the February and same as the March. So the total raw material required for the production, like the eggs, the number of eggs required for the January is 4,500 into 1.20, so it comes 5,400. The same as you can calculate for the February and for the March. So the total number of eggs required for the total production is for the first quarter is 19,656. As we need to add a closing inventory for every material we purchase. So the total will be 5,400 plus 1,296 so it comes like 6,696 for the January, and you can calculate same as the February and the March. So as you all know that we don't have the opening stock in the January, so the total number of eggs to be purchased is 6,696 minus 0. It comes like 6,696. So the cost of the egg is 8 cents per egg. So the total cost is 6,696 into 0.08. So it comes 536. So the total cost for the eggs is 1,722. So we'll start with the cocoa powder, chocolate chips, and vanilla extract. The number of the donors will be the same. The raw material required in the cup per dozen is for the January 0.66 is the same as the February, same as the March. So the total raw material required for the production is 2,980 for the January, and same and you can calculate for the February and March. And we have to add the closing inventory. So the closing inventory is 716. 8 for the January. The total will be 2,980 plus 760. So it comes like 3,697. As you all know that we don't have an opening stock, so the total raw material required to be purchased for the January is 3,697 minus 0, so it comes 3,697, and the cost per unit is 50 cents. So the total cost for the January of the cocoa powder, chocolate chips, and vanilla extract will be 1,849, and the total raw material purchase cost of raw material purchase is a total of all the materials that we the eggs, the flours, and the baking soda. It comes with 536 plus 1,849. It comes like 8,662. So the total material cost for the first quarter is 26,930. So at the end, so as you can see here, the cost of raw material for inventory 31st March is so we require the unit is 6,065 for flour, sugar, and baking soda. The eggs is 1,866, and same is the vanilla sour cream, vegetable, and milk, and the cocoa powder is 1,036. So as you can see here, the total unit cost of the each product is given. So the total will be 2,440. So the cost of goods sold, how we calculate the cost of goods sold is the total purchase of the material will be 26,930 minus 2,440. So it comes like the total goods sold by it comes like 24,560. Thank you.
Hello everyone, my name is Parneet Kaur. Today I am going to represent the labor budget over there. In our London pastry, there are total 9 employees. 4 employees are working as an indirect labor and 5 employees are working as a direct labor. In our indirect labor, there are 4 employees as I told earlier, in admin staff and bookkeeper and a retailing. And in administrative staff, there are 1 employee and the pay rate for that employee is $15 per hour, and if he will work for 8 hours, then it will get $120. And the same thing is for bookkeeping. But in the retailing staff, there is a same pay rate, but the hours are increased. That will be 10 hours, and the total amount will be $300. In the direct labor, there is a production facility. Because we are high skilled worker over there, then that's why their pay rate is $45 per hour. So the total amount will increase to $1,800, and the total labor budget is $2,340. In the manufacturing overhead budget, if we will produce dozen of chocolate glaze, in January there is a 4,500 quantity, and in the February it will increase to 5,400. In the March it will increase more than the February, 6,480, and the total will be 16,380. In the manufacturing overhead, if we will calculate the per dozen, it will be the 0.90 for every month, and when we will calculate the total variable overhead, we will calculate 4,500 into 0.90, and we will get the 4,050. Same will be happen to the February and in the March. In the total fixed overhead, we have 2,000 for every month, and that will be goes to 6,000. And in the total manufacturing overhead, there is a 605 that will become 5,5050 plus with 2,000, and this will be happen for every month, and the total will be increased to 20,742. In the depreciation, we will get 1389 for each every month, and when we deduct this, then we will get cash outflow for manufacturing overhead in the last, and this will be the same. The depreciation will be the same for all months, and the total will be occur 16,574. In the income statement, there is a sale that is 65,586, and this will be occur via the direct labor. The direct labor is 24,516.90, and the manufacturing overhead is 16,574 and 25. In the total cost of goods sold will be occur by sum of the 24,516.90 with the 16,574.25, and we will get the total cost of goods sold. In the gross profit, we will get the gross profit by subtracting the sales that we will have and the sale that we will get. Okay, and the less operating expenses, we have 19,785, and the less interest expense will be 960. When we will calculate the operating income, we will subtract all three, and we will get 3,749.85. In the income tax, we will have 25% income tax less, and we will get this 937.46, and the net income will be 2,812.39.
Hi everyone, I'm Ajib. I'm here to present the cash budget of our Lantern Pastry. We all know cash budget. It is the inflow and outflow of a company. So when we calculate cash budget, we'll get a clear idea to proceed the next months. Like in a specific time, we'll calculate the inflow and outflow. So we'll get the we can calculate whether we have a sufficient cash to operate for the next months. So right now in our Lantern Pastry, we calculate the cash budgets for the first quarter, like January, February and March. And when we going through the inflow, we have an opening cash balance of 0 in the first month because we just started in the January, but we have a capital contribution of $20,000. So the total cash in our hand, it will be $20,000 in the first phase. And when we calculate the outflow, we have direct material, manufacturing overhead and operating expenses. When we add together, it will comes around 55,000. And the equipment purchases, that's the 55,000. We are buying something. We'll say about this one in the next couple of slides, the equipment cost. So we have an equipment purchase of $55,569. So the total outflow, that in the January we will spend $67,837 in the January only. So there will be a deficiency of 47,000 just because we have a cash inflow of 20,000 only. So for that one, to meet the deficiency, to make it as an efficient one, we have to borrow some money from the bank. So we are borrowing $60,000 from a bank. So the cash in our hand will be 80,000, and when we reduce this one, the total with the equipment purchase, the total in our closed balance will be 12,163. So we can use this one as an opening balance for the February, and in February the total cash will be $37,163 because we are adding capital contribution of $5 extra. So 20 plus $5,000, it will be $25,000. And the cash flow, we don't need to calculate the same thing. We are just adding as a multiple of these ones. So it will be like 17,663. And we are not buying anything in the February because we already bought the equipments in the January itself. So there is no financing, but we have to pay the borrowing repayment plus the interest. So the repayment will be 10% of the total money. So it will be $6,000, and the interest will be 10% of the repayment money. So it will be 600. So altogether it will be 660. So when we deduct that values from the money we have, it will be a closing balance of 12,900. It's almost looking like same in the January as well. So we can use this money for the opening cash balance of the March. So when we calculate that one, 42,000 will be the total cash in our hand in the March, and we don't have that much expenses in the March, but we have a $30,000 as a capital contribution that helps us to meet 42,000, and we have an efficient budget in cash in our hand like 19,000. So when we add together, and the repayment will be 5,000 in the third month. So and the repayment interest will be $500.40. So the closing balance in the March will be 13,755. So when that's the closing balance in the March. So when we tallying these values, we will get the same value as a total. So 13,755. That will be the closing balance. And we can next one. It's the balance sheet. We all know balance sheet definition. It's the basic of every organization. We are doing like it will be in like a not in a specific period of time, but it will be like we can do in a quarterly or annually manner. So if you are doing like cooperative organization, then it's the best thing to explain everything like assets, total current assets and liability, equity and everything. So it will help us to find out the loss profit statement. So in assets we have a cash balance as we said earlier, 13,755, and account receivable we have 35,000, something like that. And stock raw material, as we calculated in direct material, we have a stock material still $2,414. So the total current asset in our hand will be 51,000, and in that we have a fixed asset of 55,000, and we have to accumulate the depreciation cost. We have to less that one, so it's $4,000. So when we calculate that one, the total will be 51 plus 51, it's 103, like $1,03,344. So that's the total fixed asset in our hand. We have a liability and equity that we have to deduce from these values. That's the account payable, notes payable. It comes around 25,532, and the equity. That the equity, we all know what's equity. So the capital contribution and retained earnings are the equity here. 75,000 and 2,812 is the total equity we have. So it comes around 77,000 when we calculate this one. So it will be the total assets in our hand, and this will be the equity. What to say, like loss in our. When we calculate the total equity, it will comes around the same value. So we can see that there will be no balance. It's balanced and there is no remaining money. So it's a fixed balance sheet. We already balanced that one. And next I'm talking about the equipment cost. We are buying new work tables, spiral dog mixer, rack ovens, and we have some depreciation cost. We will calculate that one. We need a 25 by 40 work table, 30 by 48 work table, 30 by 60 work table, and 30 by 72. We are buying that one. The quantity we needed only one, because in initial stage we are producing only few donuts. So not few, but it's still few, and we need this much only for producing that one. And we are buying only one spiral dough mixer. We have the value, we already purchased that one, and the value will be like this one. And for the spiral dough mixer, its value is little bit more, but we have depreciation. 21,619 is the value of spiral dough mixer, and rack oven also we needed for stacking all those things. It's like 33,000 will be the rack oven's money. So in total, we have to pay 55,569. That's we paid already in January to buy all those things. That's why in the calculation we had a deficiency. And the total depreciation in this for the equipments, like we are calculating per annum. So 30% is the depreciation. So 55 into 0.3, it will comes around 16,000 something. And for the per month, we have to divide this one with 12 like per month. So it will comes around $1,389. Thank you. That's the equipment cost.
My name is Shivam Bhardwaj, and I am here to tell you about the break-even analysis and the conclusion part. To start with break-even analysis, first we need to calculate sales price. How do we calculate sales price? Sales price is calculated by sales plus total variable cost. In cost, we have three things: direct material, direct labor, and other variable cost. and the total comes out to be 1183. And to calculate sales price, we need to add markup on total variable cost, that is 40% of total variable cost, which comes out to $4.73, and the sales price per dozen is 1656, it is in front of you. To calculate the total other variable cost per unit, we need to add total budget manufacturing overheads plus total budgeted variable operating expenses, and the total comes out to be 27027. And therefore, the total production quantity is 16380, and we give it name B, and the total of other variable cost is 27027. So to calculate the other variable cost, we need to divide total divided by total production quantity, which comes out to be 1.65. Now to calculate the total fixed cost, we are doing it for 1 quarter, that is January, February and March. And to calculate total fixed cost, we need to add total budgeted fixed manufacturing overheads plus total budgeted fixed operating expenses, and the total of 1 quarter is 13,500. And if we talk about contribution margin, we do calculate by sales price less total variable cost. That gives us the contribution margin per dozen. So the sales price over here is 1656, and the total variable cost is 1183, and the contribution margin per dozen comes to 4.73. And now we will talk about something, break-even point. What is break-even point? Break-even point is a point where we are neither getting loss or neither getting profit. So it's a kind of equilibrium. So how to calculate break-even point in units and how to calculate break-even point in amount. So in units, we need to divide total fixed cost by contribution margin, that is 13,500 divided by 4.73, which comes out to be 2,853. That is our break-even point per dozen in units. So to calculate it in amount, we need to do the same procedure as total fixed cost by PV ratio. And PV ratio is calculated by contribution divided by sales. So that total fixed cost is 13,500 and our PV ratio is 0.29, which comes out to 47,250. And if we talk something about marginal of safety, we do calculate it by current output minus break-even output. So our marginal of safety is 13,527. So at last, I need to conclude. So in conclusion, I need to say that our basic motive is our customer satisfaction. We will get our customer satisfaction if we give a good quality product. As I talk furthermore about the conclusion, I am very much happy with the location. As in London, we have 2 main locations. As in London, we have 2 main universities like Fanshawe College and Western University. As in between that, we have a shop. So our main basic motive is to get the students to retain them. So by giving them good quality products. So we are located in Huron and Highbury, and it's the most convenient location for both of the students. And at last, we are also working on to provide free delivery after a couple of months. We are working on it, but we'll tell you about it very soon. And at last, we are only concerned about customer satisfaction, and we will meet our goals and break-even point very sooner. Thank you.